It's panic at the top. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, it's full panic mode as the president of a major superpower is now being forced to respond to an unthinkable threat. And is the U.S. banking crisis back? Well, the Fed says no way, but we have some new evidence that says it might be back and bigger than even before. Now, let's head over to Bloomberg, where he picked today's story up with a headline as President Xi to discuss China's stocks with regulators as rescue bets build. Now, here in the U.S., we normally don't hear about a president coming in to discuss what's going on in the stock market. But in China, of course, business there is much different. And when a tumbling equity market threatens to unravel the very fabric of their economy, take out their property developers, their banks, and even worse, demand for their consumers, well, you better believe President Xi Jinping is interested in this in a big way, because it says, well, things there are far worse than we think. As Chinese stocks extend their rebound after Bloomberg reported regulators led by the China Securities Regulatory Commission plan to update the top leadership on the market conditions. Well, maybe they could just turn on the news and the latest policy initiatives, according to people on the inside. And while it's unclear whether any new support measures will come out of the Xi meeting, traders are hoping this time will be different, as some $7 trillion of value has been wiped off Hong Kong and China equities since their peak in 2021, and piecemeal approaches to support the economy and stabilize the markets have so far failed to lift sentiment. And this is really important, because oftentimes we hear about that the stock market leads the economy or the stock market is the economy. Well, here in the U.S., the stock market is the economy. When it's booming, well, it tends to pull everything up with it. And as we look around the world, we see those same effects. Sentiment in China domestically is in the toilet. Demand is down. Domestic consumption is down. They're starting to see deflation in their consumer price index. And one thing that could change the tide would be to get the equity markets up there. The problem is they're continuing to plummet. But yet for policymakers, it's important to stabilize the stock market to avoid further hurting consumer confidence as China enters its week-long Lunar New Year holiday, suggesting that perhaps any mention or even just a meeting with Xi Jinping would get everybody on alert that even the most powerful man in China has an issue with the stock market, and that a major turnaround or further policy support will be in the works. And this is important because when we talk about consumer sentiment, well, it's very clear. As we look at the U.S. data here, you see the Wilshire 5000 price index. This is a total U.S. stock market. We're going to overlay this against the University of Michigan Consumer Sentiment Survey. And what we tend to see is that when equity markets go down, well, sentiment falls with it. And that's really important, because a rising stock market, well, it drives, of course, confidence. And what we know, when consumers feel more confident, they do one very important thing, and that's they tend to go out and spend even more, because they feel the wealth effect. This is something going back to Alan Greenspan that the Fed recognized is very important, is keep the markets from crashing at all costs. And here we can see sentiment rebounding right now, as, of course, the equity markets are sitting right near all-time highs and looking like they want to continue to go higher. This is an important issue in China, because if you're struggling with consumer demand, which they are, well, a declining stock market isn't going to get people out to spend. And in fact, it's going to expose all of the rot in your financial system, suggesting that perhaps Xi Jinping will step in and take over here to make some new policy announcements, because the other important part of this is domestic consumption and the tie has to, of course, the equity markets. Here you can see the Wilshire 5000 again in blue against advanced retail sales, that's shown in red. And we know that China is struggling with domestic consumption, and the equity markets there aren't helping at all. Here we can notice that as the equity markets decline, on a year-over-year rate of change, of course, when we see retail sales go down. We see that happen here again during the global financial crisis. And look what's happening now. We're starting to see a resurgence in retail sales. This is very important. What have we noted in the factory sector recently? That new orders are up. We see this in the services sector. And what are some of the reasons we're hearing out of the factory sector? Is very simple. Respondents to the questionnaires are saying, look, we're optimistic about the economy. And what would cause that? Is it foot traffic? No, it's the equity equity markets because they know if stocks go up, well, people tend to come out and spend. The only risk is when the people don't go out and spend when the stock market's rallying. Well, that tells you there's something deeply wrong with the financial system. And we'll get to that in a bit here because as we talk about the U.S. banking system, well, it tells us something really bad may be on the cusp of happening again. But back to China, as the news that the nation's #1 is holding a meeting encouraging development as it shows that the plunge is getting close to punching through the authorities' comfort level, suggesting that China will do anything it can to put a halt to its equity market. Talk about investment opportunity. It gives me the impression that they're doing everything they can, apart from calling out to the market that now is the time to buy. And of course, when people believe that governments are going to come in and put an implicit bottom in the market and put support at any cost, well, it means that money is going to flood in a big way. And sure enough, foreign inflow surged as overseas fund added more than 12 billion yuan or 1.7 billion of mainland shares on Tuesday, the most this year. This is the market saying, yes, we want support from the government here, and this is something that you could trade. In fact, we highlighted this on our Sunday show. Now, many of you said with your CTA Timer Pro, we look at the machine position. We've been showing you there was extreme positioning in the Chinese equity market. This would be huge opportunity for you. Many has said, Steve, I don't have time to look at your report every day. Can you put the obvious signals on page 1? Well, they're out and they're live, and we got a guidebook coming soon as once we get approval on it, give you step-by-step instructions how to use the report. Here you can see back on February 3rd, we saw it come off of this massive short selling on the fast machines and against the slow ones that are falling behind. But what happened here is real critical because we run a historical overlay. We give you the edge. When we say something's an extreme position, opportunity is knocking, and sure enough, it did. Our Momentum Timer Pro picked it up the day before this on February 2nd. Many of you said, can you put your high value signals on page 1? Well, you got that as well now. Here we can see that coming off a sell minimum on the 1 month window, showing that momentum, this is what our report does. It looks at those things like the RSI and the MACD and other technical signals, but it smooths them all out, makes them easier to trade. Well, we see a reversal here on this window of course, going back on the same time. That triggered a buy and open. Had you did that, of course, what we know is that you'd be about 1.99% right now. Not bad for 7 days of trading. Of course, you can get in. There's still some of those free coupon codes for a free month. You can grab the new reports. Many of you said, if you make it easier, I'll be back. Well, now's your chance to get back because the fact that a special meeting may have been called could indicate that things have become so bad that it needs to be reported to the top. And if there were to be a report from the state media on this, I would say with confidence this is a pivot point as concerted actions are also now seen. That means, of course, a rally in Chinese equities. And as a subscriber to our reports, you now have all the tools to take advantage of that. And it's still early. Jump on those reports because there's even more coming out of China as margin debt drops the most since 2016 amid stock rout, suggesting that maybe this downward move is over as speculators get washed out. That's always a big sign of market bottoms when you see, of course, a lot of margin debt get flushed out of the system. As China's also tightening trading restrictions on domestic institutional investors as authorities fight to put an end to the sell-off. Some quantitative hedge funds have been banned from placing sellers. Hey, you can only buy but never sell in China. And while a channel that can be used by mainland-based investors to short Hong Kong stocks has been curbed. Equity gauges rebound today in a big way as China's state fund said it will continue to increase holdings of exchange-traded funds to maintain the smooth operation of the capital markets. And we brought you this first based on our reports. Critical. Again, links in the description below. Grab that free month coupon while supplies last. But let's talk about the U.S. banking system. Are we on the cusp of another March crisis? Except we said if it happens again, it will be far worse and unstoppable. We've heard from policymakers, we've heard from the central elites that this can't happen. It won't happen again. The United States banking system is strong. Well, we're starting to see some cracks in that. Before we get to that, I want to talk about, of course, what what the report that came out yesterday, that banks tightened credit standards for the fourth quarter because it's all matters. The health of the U.S. banking system has everything to do with lending. When banks are making new loans on net, that's how they make money. Well, the banking system creates deposits, and then, of course, that means they're on solid ground. When you see a contraction in lending, when you see financial conditions tighten, it's never a good sign of what is to come. The net share of U.S. banks had tightened standards on commercial industrial loans for medium and large businesses compared to the prior period dropped to 14.5% from 33.9% in the third quarter. That was the smallest such share since 2022, meaning on net fewer banks tightened lending standards. Now the key here, my friends, is that banks are still tightening lending standards. As a whole, it doesn't mean that, of course, they're easing. They're still tight, just a few of them tighten more. And the key part here is when banks tighten lending standards, when you go in to put an application in, that means people get rejected. They don't get the loan. And this is critical because commercial banks are the only institutions in a debt-based system that can create new money. So if they're not creating new money, then it starts to become a question is how do you support the growth and debt of the economy over time? You run short of money and everything starts to break, including the equity markets. And here we can see the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes, and on net, fewer banks tightened standards last quarter. I'll show you why that is, and because the Fed, they don't get it. In fact, the new report suggests a severe credit crunch feared in the wake of the collapse of 4 regional lenders last year hasn't materialized. Well, hang tight, it's coming. And while high borrowing costs have more broadly weighed on households as the Fed has lifted interest rates to a 2-decade high, the economy has remained resilient. Again, it's no different. When you think about this as your car, when you're driving down the road and it starts running out of gas, you see some indications that, well, it's struggling a little bit, but hey, we're still moving forward. We're all okay until it stops, until it actually runs out of fuel. It's the same way with debt-based economies. You need a creation of new money and enough of it to support the growth and debt. We have a fear in the spring last year that the collapse of Silicon Valley Bank and a few others that would lead to a credit crunch. This from Chicago Fed President Austin Goolsbee. I'm going to prove to you he doesn't know what he's talking about, doesn't know how the system works. We mostly haven't seen more credit tightening than what you would expect from just the monetary policy. And the rates, I would characterize that it still feels like more of the same, suggesting he has no idea why banks are not tightening as much. It's everything to do with the yield curve, Goolsbee. It's very simple. Banks make money when long-term rates are higher than short-term rates, but because you and your Fed cohorts reverse the system, well, they don't want to lend as much. But here's the good news. You'll notice that the yield curve, shown here in red, is getting closer to that horizontal black line, meaning they could possibly get close to making some money, which means they don't tighten as much. Now, if we start to see rates fall here, and we see a yield curve shown in red go higher, we'll look for banks that tightening lending standards in a big way. This, of course, is one of the reasons why the market is so aggressively short the long end of the curve. They're trying to normalize it because they believe in the no landing. But yet the bond market says not a chance, because here's what's happening to commercial industrial lending. On net, it's in contraction. Here you can see commercial industrial lending in red on a year-over-year rate of change. And when banks tighten lending standards, well, lo and behold, they originate fewer loans. And you do that long enough, and it goes into contraction. So think about this. If banks make money create money by originating new loans, well, what happens when it goes into contraction? When you're not creating enough new loans to offset the number of loans that are being paid down or paid off every week? Well, that means money is destroyed. In a debt-based economy, that is one of the worst things that can happen. We're in the early stages of it. It took a long time to work through all that pandemic stimulus. It took a long time to work through all the loans that were created during the pandemic. And now we're seeing the early signs. We're headed to contraction. And that means, of course, money being destroyed. And this leads to, of course, banks being destroyed as New York Community Bancorp collapses near 27-year lows after talks with regulators have been revealed. And this is a problem because this means that the banking crisis never went away. This is something we said back last year, that what the regulators did is wallpaper over the rot in the banking system and hope that it would fix itself. And we've been watching this and monitoring it over the last year. And what have we seen? No improvement. Absolutely none. In fact, if anything, We've seen the banks are in a worse shape as the global economy slows down. And all this happened the week after the Fed officially killed its free money arb and confirmed the imminent death of its bank bailout facility as reverse repo liquidity pool is draining fast. And this sends all of New York community bank shares down 14% today, this morning, after falling 11% yesterday. And the New York Community Bank is still building reserves as part of its widely expected transition to more stringent capital rules. Now, what do they mean by reserves? They mean deposits. They mean cash. Having money set aside there for emergencies is what banks need. They need deposits. But I just showed you, if banks are on net not originating enough new loans to offset the ones that are being paid down and paid off, well, what does that mean for deposits? It means they're going to go down because deposits are created. If you guessed it, when new loans are created, you got it. And that's a problem with the system right now because New York Community Bank needs deposits. Well, they can't get them. And that's all this is after the lender swelled beyond $100 billion in assets when it acquired parts of Signature Bank last year. And given the massive drops in deposits last week, this noted from Zero Hedge, well, they're wondering if Silicon Valley Bank 2.0 is about to hit and prompt those Fed rate cuts that we've been promised later this year to be pulled forward this morning. And as a result, of course, interest rates are going down. Bond prices are going up because the bond market is sensing, look, the system is running out of money. It's been doing that, and it's going to get worse, a little bit worse every day until all of a sudden something snaps. And here you can see from a deposit perspective, when banks tighten lending standards, of course, what do you notice? In red, deposits go down and slow the growth of it. We notice that deposits have really never been on a negative glide path except back in around 1993 and early 1994. This is the only other real time we have in the data here that we can show that when banks tighten lending standards, of course, deposit growth goes negative. But we can note that deposit growth does indeed go down because, again, as it all comes back to, if on net you're not originating enough new loans to offset all those loans that are getting paid down and paid off, well, deposits get destroyed. That's just how the game works in a debt-based system. And yet many still say that there's no chance that we're going to have a recession, no chance that anything is going to go wrong, including one major bank as Deutsche Bank, an early Wall Street bank on the prediction of a U.S. recession, says now we're scrapping his call. We're not doing that. They went back in 2022 and said, look, we think there's a recession coming. No chance now because there's no damage to the labor market. Well, hold tight, my friends, because when you look at the net percentage of banks tightening lending standards for commercial and industrial loans to firms of all sizes, again, still in blue against continued claims, this is real important to note that as less money is being created in the economy, well, guess what? You don't have demand. And when you don't have demand, you can't afford all the labor force. And sure enough, what happens is people get on unemployment and they stay on unemployment. And that's what we're seeing now. And over the next several weeks and months, we'll be watching continued claims. If they continue to tick higher, well, it's evidence that, again, we're running out of money. The end game here is coming sooner. In fact, we're seeing it in some other countries like the UK as retail sales slow as consumers tighten their belts. Well, maybe it's not that they're tightening their belts. Perhaps they just don't have the money as demand there goes down. Total sales increased 1.2% in January compared with a 3-month average of 1.9%. This is according to the British Retail Consortium. The figures are not adjusted for inflation, which was 4% at the end of last year, suggesting, as we've been warning, that inflation-adjusted retail sales are not keeping pace. Not a good sign for retailers. And how about Germany? Factory orders unexpectedly advanced at year-end. Is this hope that, of course, they're coming out of their factory depression? Well, not just yet. Demand did rise 8.9% from the prior month, which is huge. And this massive increase in orders can't obscure the actual situation in the German manufacturing sector, which remains very tense. Just from an economist at asset manager Bantleon, the collapse in orders in the automotive industry and mechanical engineering, both the backbones of the German economy, is particularly alarming. The prospects for production therefore remain poor for the foreseeable future, and this isn't a good sign because when it all comes back to the equity markets that everyone is piled into the same 7 stocks, when banks tighten lending standards, I warned you at the beginning of the show what's facing in China. We're coming all the way back. What they're doing in the end isn't going to work until they cut rates. That's the whole point here. And sure enough, what do we see? Banks tighten lending standards. Eventually, the equity market, now shown in red of the Wilshire 5000, doesn't have enough money to sustain sustain itself. And next thing you know, stock prices come down. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.